This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Scott Fulford. He is an economist. He is the author of The Pandemic Paradox. He also happens to work at the Consumer Financial Protection Bureau. Scott is a data guy, and we get into the data, beyond the data actually, of the entire COVID time period. The economics behind it, the finances behind it, the social aspect behind it, everything that unfolded during that period. Scott takes the case that Americans, on the backside of it all, have come out better financially. I push back. That's what makes a great conversation. I hope you enjoyed this conversation with Scott Fulford. I think the best place to start, and I usually don't do something like this, but I think the best place to start is probably the title of your book, because it does and it will cause people to instantly want to know what your perspective is, and then I'm here to ask some questions. But the pandemic paradox, how the COVID crisis made Americans more financially secure. Now, I personally don't see that or understand that perspective. Now, you're a deep data guy. You're going to lay out some perspectives. I think if I start at the money supply increase, if I start with inflation, here we are in late 2023. That feels really problematic. Help me to come into your world. Give the opening salvo. I know there was some survey and some data research that started this project, but bring me into how this started for you.
Well, sure. So let's go back just a little bit, because I think it's worth setting a little bit of stage, and then we can think about maybe what's happened over the last year and a half, 2 years, and that may change your perspective. And I think that's a fair thing to think about, and the world evolves. Taking everybody back to March 2020, that was a scary time. And it was scary financially. It was scary because there was a new virus. If you were in New York, people talk about hearing the sirens go by. And it was a scary time partly because over about a month, something like 22 million people lost their jobs. At my job, what I do is I'm an economist, and I think about what happens to people when they have difficulty making ends meet, when for whatever reason things don't line up and they have to figure out how to make their payments. And so I was looking around at this data and thought, oh my gosh, this is going to be really scary. I had been running surveys, and something like 40% of US households wouldn't be able to live for more than about a month without cutting their expenses if they lost their main source of income.
Can I stop you for a second? The part of the losing the jobs, that part right there alone, you say as a matter of fact, it is a matter of fact, it did happen. But there'd be a lot of debate about that in of itself. The whole idea that the jobs were lost, the whole idea that things were stopped. How do you see that? Because that becomes really critical. A lot of people would say, well, hold on, there was no right to do this. There was no legality to do this. This just happened and it was thrown upon me. Yeah, okay, you're correctly saying the jobs were lost and now what do we do? But how do you feel about the point of the jobs being lost and the whole process of that happening? That was a huge, unique thing for America, correct?
It was. Two pieces there. So for people who lost their jobs, I mean, whether or not we, for the most part, have at-will employment, and so people can get fired or furloughed more or less at any time for more or less whatever reason. The more or less is important because there are some caveats there that matter.
Unless they work for the government.
Yes, fair point. So the more or less is important. But for the most part, the jobs that were lost, in fact, were businesses looking around and saying, well, wait a second, people aren't coming into restaurants anymore. For example, some of them were because of direct shutdown orders, but those were relatively minor. A lot of these shutdowns, actually, shutdowns as in businesses shutting down, occurred even without the actual order. So some of the analysis that's been coming out has fairly convincingly shown that the shutdown orders tended to come after businesses were already shutting down. It was largely just a demand that people weren't going out to restaurants, weren't traveling as much. even when they could legally do so. And when you run a business and you don't have demand, then the thing that you can cut is your costs.
I don't want to go off on too much of a tangent, but clearly the lack of a demand came from somewhere beyond just the virus. Obviously, there was messaging, there was government orders, there was government messaging as well. There was a fear put out there. So again, you're asking us to go back to March of 2020, and you're right, especially with the American stock market going down and whatnot. And I was in Asia, so we had already seen some of this a couple months in advance. We had already seen some of this fear happening before it got to America. So it's like this slow moving thing to where all of a sudden we were watching America. Okay, now America is seeing something. It's a complicated issue in the sense that how did we get to the lockdowns? How did the lack of demand happen? I don't want to stay there too much, but those are definitely big issues to talk about.
Maybe a different way of putting it is I think there's a real question that I think we are still having about what was the right level of fear and what was the right level of not going out and avoidance. What were effective ways to reduce a virus that was spreading without causing more harms? So just to give an example that I use in the book, and I think this is a really important one, I think it's become pretty clear that schools should generally have opened in person. Maybe it was unclear in, say, the spring of 2020, but fall 2020, schools really should have been. It
was clear by then.
Yeah. Things were evolving. It was complicated, but ex post, it looks very clear there was a lot of learning loss and there wasn't much transmission in schools. And there would have been a lot less learning loss had schools opened in person.
And let's be frank, most likely a good portion of that was the teachers. If many of the teachers were in what would have been a typically described compromised position, obesity, comorbidities, etc., the teachers did not want to teach because we knew, and we can see now, especially in hindsight, that there's a whole group of kids that have been really harmed by this for the educational reasons.
Yes, but to be fair, if you were a teacher and were suddenly being told that you had to come in to face this new thing and you have some bargaining power over that, I think it's clear afterwards that the risks were not as large as I think many people thought they were in schools anyway. There might have been other risks that were underestimated. But while the costs of learning were quite large, but there's a real sense that many people felt like real risks were being imposed upon them. We also didn't know. Things became more clear over that year. And as we were able to, social scientists were able to actually look at the schools that opened versus schools that didn't.
I'm curious your perspective on this too. I think we knew by, especially the fall of 2020, we knew essentially the type of physical condition to be in that put you at highest risk. And I think the thing that I still find strange all these years later is, number one, we did not tell people directly and openly, hey, being morbidly obese is the number one issue. And instead of using that time to talk about dropping weight and whatnot, we just didn't do it. And to me, it feels like, in hindsight, and I don't want to stay here on this particular issue much, but it feels like in hindsight, what we did was we looked at the population and we said, okay, there's this group of people that are at high risk, mostly obese people, and let's then try to get everybody else to conform in some way, whether that's distancing or masks or vax, and the efficacy of all that can be debated. But let's get most other people that perhaps are not in this compromised position to conform to protect those that were in a compromised position. Is that a terribly unfair way to look at it? It seems rational to me.
I think elderly were also at risk. I think there is a real sense that as a society, we want to be thinking about how to protect vulnerable members. As always, there are costs to different things. And so I think we want to be cognizant of different kinds of costs. But in some ways, a very, and I'm using this word very particularly, a very conservative position is thinking about, well, what is my place in society and how am I helping other people in society? That's part of a social value and viewing yourself as part of a society.
On the flip side, though, is like you said, the costs were immense.
Yeah. So in figuring out how we should have weighed those, but coming back to maybe just as a general theme, but I think is worth just thinking about, is that in many cases we were just making decisions in uncertainty and with uncertainty and things where things were evolving in ways that were complex. And I think that was true both of for the virus, where I want to just admit that I'm an economist, not an epidemiologist. The appropriate way to combat the spread of the virus is something I don't know that I have a particular viewpoint on, but I do have a strong viewpoint that we really were trying to make good economic decisions based on imperfect economic data. So figuring out what the right thing to do was often very hard.
Well, let's keep it at that for a moment, because I think it starts to get more into your world. Essentially, and you can clarify me if you don't like the way I say it, but essentially, we created more money and gave people money, and we hoped that inflation would not take off. Fair assessment?
Coming back to March, May, April 2020, the big fear actually was deflation. I'm not sure if you remember, but I think it was May 2020, the price of oil, I think it was Brent crude, actually turned slightly negative. People were actually being paid to take the oil. That was a very weird time.
That probably would not have lasted. I mean, markets have a funny way of figuring out where they need to be. You know, there can be fear and markets will go one way, and then the markets realize, oh, shoot, there's an opportunity here with oil. We're not going to price it below zero.
Below zero was a very weird time. My understanding was it takes a while to ramp down supply, and demand had gone way down. And so storage was an issue. And so briefly, it became enough of an issue that you really didn't want the oil because you couldn't store it. And that can work out fairly quickly, but it just takes a little bit to work it out. More broadly, there was actually a real fear of deflation. And the thing about deflation is that that's where the Great Depression comes from. That's where real economic harm comes from. Inflation matters, but I think there was a general thought that we had not really seen much inflation for many, many years. And what might have happened from inflation was not necessarily the worst thing that could happen. We lost a decade of growth after the Great Recession. With low inflation, I don't think I would prefer to have an economy where I lost a decade of growth and low inflation.
You bring up an interesting point, and I'm sure you've thought about this too, but if we go back in time, I still remember me getting out of grad school in middle of 94, and then all of a sudden the dot-com era takes off, and we get the whole thing that takes off, and we get to 1999, the NASDAQ goes up 100%. All of a sudden, March of 2000, we get the break. Then we bottom out on the NASDAQ in the fall of 2002. At that stage, okay, we've now brought rates down to close to zero, and then we get the buildup. As everyone saw the Big Short movie, we know how we got to the Great Recession. Obviously, we then dropped rates down to terribly low for this entire time that you're talking about post the Great Recession, basically zero rates. A lot of things unfolded from that. Stocks going up, things like crypto happening. I think the interesting point, and I'm curious your perspective on this, we get to this March 2020 perspective, and you've got the COVID thing hitting at a similar time to where people might already be saying, we're due for something to happen economically on the negative side already. Do you see what I'm saying? Because we've seen this in our lifetime. We've seen these 50% meltdowns happen when we get overextended. And when you keep low rates, and just got the feeling that it would not be surprising that if all of a sudden we started to see interest rates go up again for the first time in over a decade. And then if rates start to go up like we're seeing now, that creates a lot more uncertainty. Obviously, it's a big picture perspective I'm putting out there. Feel free to comment.
It's hard to remember what 2019 looked like, but at least in the United States, one of the things that people were talking about was, oh my gosh, we've just spent 10 years of growth, which I know the economy had been growing pretty steadily. It had that big decline in 2008, bottoming out in 2009. We'd actually had, I think, the longest expansion in US history.
At a cost that every saver did not get a dime of interest for a decade.
Fair. Interest rates were really low. But to be fair, inflation was also really low. So inflation was below the Fed's target for most of that time period. And unemployment was fairly high, particularly long-term unemployment for the first 5 years of it.
Let me bring you back to the meat of where you're at, though, because you make the perspective that Americans come out of the COVID crisis more secure. So I was just back in America in September, going into a McDonald's and seeing two people can eat for $40. And you're like, okay, something changed here. For me, I look at the home price affordability in America currently in 2023. I look at the inflation. I look at rates clearly have moved up, along with equities still staying at all-time highs. So for me, as a guy that looks at longer windows, I say at this moment in time, well, gosh, everybody's happy. Home prices are high and stocks are high, and now people are getting interest income. But generally, when those things are all together, they don't stay all together for long. Usually something breaks. Give me your perspective.
Ooh, well, something breaks. I have to admit, I think a lot of people have been thinking that that something was going to break for the last year. So far, it hasn't. We're right now in November 2023, just to date things. So far, it hasn't. The recession that I think many of us thought was going to happen hasn't occurred. But I think it's worth just putting a little bit of a what happened, just to describe a little bit. You can maybe pull back and think about whether you have perspective on the data I'm using. But I think this is pretty well established in lots of different data sources that we had all that unemployment coming out in March and May 2020. And yet, by a lot of measures, by June, July, August, people were just generally doing better financially on average. And that was true for unemployed people. It was true for people who were unemployed. Well, it's true for people who were working from home. That doesn't mean everybody was great. Doing well financially is not the same as doing well, but it does mean that by lots of those measures, I think people were doing really well.
To clarify, though, that happened because the government made new money and then sent checks out. Fair?
It happened for two things. Money creation is a complicated thing, but the government borrowed money and sent it to other people. And it had sent it to lots of different kinds of people. So that was part of it. But a big part of it was that people weren't spending as much, that many people made decisions about travel and restaurants, some because restaurants were just closed, but most often it was just didn't feel like a good idea to be going out to a restaurant right now. And that meant that there was a lot of accumulated savings. In many ways, those accumulated savings were even bigger for high income areas. So the decline in spending was even larger in high income areas than it was in low income areas. And putting that together, it meant that people just had higher savings and higher incomes that were coming in, while the government support was mostly keeping the bottom from having really large negative consequences. So overall, liquidity was really high and people were able to manage all of the things that just happen in life, all of the cars breaking down, people getting sick, that kind of thing, because they had money in the bank.
Okay, so that's 2020. Do you connect that increased money supply? Do you connect that to today in terms of inflation?
Yeah, so then let's work our way back. Lots of money around. And the problem was that as then the economy started to change, so people were ordering, for example, more physical goods. My favorite example for this is exercise bikes. To disclose, my wife and I bought an exercise bike.
The Peloton phenomena.
We did not get a Peloton, but the Peloton phenomenon is, I think, a really big deal. What was happening there? Well, people were substituting going to the gym, which seemed a little risky suddenly, for working out at home. Okay, so they had to get new equipment to work out at home. That equipment had to come from someplace. It had to be made from someplace. That generally meant a container ship, which meant a big backup at ports, changes in prices because everybody was ordering bikes. Something similar happened with used cars briefly when people, oh, I need to drive again. I need a car. Oh, we haven't made as many cars. Changes in what people were buying, first in physical goods, and then as things opened up, revenge travel services meant that prices for what people were buying were changing because supply wasn't keeping up. So all of that excess savings was partly encouraging people to spend more when they could on things that they wanted. And since lots of people were doing that all at the same time and supply wasn't able to keep up, that's where we ended up with some inflation.
Other people might argue that they'd say, well, hold on, the inflation came pretty directly from the US government increasing the money supply.
Other countries had high inflation too, without the same increase in the money supply. The relationship between money supply directly and inflation is, I think the general macroeconomic belief is approach to it is not quite that it's purely money supply.
Let me push back in the sense of if the way that the Fed went, if the increased money supply was a good thing in the moment, why not continue? Why not just keep that process going along? There's a cost here. That's what I'm getting at. I would argue today that here we are in fall of 2023, we're still seeing that inflation. Just to put this out there, the home prices, okay, we can argue about there's not enough supply, so then the prices go up. But ultimately, what the average home price in America since the start of the COVID pandemic has gone up what? People in their 20s today, they're not buying homes like their parents were in their 20s. They can't afford it.
Agreed. It is a huge problem. Although I would put that as much of a supply issue as a demand issue or as a money issue. Certainly higher interest rates have not helped on affordability at all. But a lot of it just comes down to that we aren't building where people want to live. I see that all over the place. The NBER effect that essentially zones out any higher density has made creating the density of, say, New York impossible in most cities.
If I think back to 99 and watching the NASDAQ go up in amazement, but then noticing, okay, now the Fed is getting serious about raising rates. And eventually it just felt like during that time period, the Fed raised rates ultimately to where an equity market bubble popped. And then it felt like the exact same thing happened again in 08, 09. Why would I be amiss to think the exact same thing is not happening now, given the speed at which the Fed has raised rates in the last few years? It sure seems like they are concerned about something.
They're concerned about inflation. I think there's a general thought that the Fed may have thought that inflation was, to use a somewhat dirty word, more transitory than it actually has proven to be, although it has come down substantially. But inflation was a lot higher than I think they wanted it to be. And I think they were really concerned and raised them really aggressively when they realized that this wasn't just going to be a blip. Whether they should also be concerned about a bubble, that's really hard. Maybe I should say the distinction between the economist and I certainly hope that we shouldn't be concerned about a bubble, but that doesn't mean we shouldn't be. I think there are a lot of differences between now and what was happening in 2007 and 6. And a lot of them come back to things that we learned specifically in the housing market from that episode. The ability to get a loan without documenting income that's fairly substantial and have enough income to be able to afford the payments is just much harder. And some of that comes directly from regulation that has changed. Whether that's going to change everything, if you get unemployed and have a big medical expense, you may not be able to make those payments anymore. And so things can still turn dicey relatively fast. The real concern in a macro sense would be that that's large enough to cause some big financial institutions to have enough losses to cause them to have a run or to have other financial problems. That was really the spreading problem in 2008.
The way I think about this, if I take it a step farther back, you get the dot-com blow up, you get essentially equity markets still flat on their back in the fall of 2002. So almost 2 years after the initial start to meltdown. 2 years is a pretty lengthy time for people. And the NASDAQ is still down 77%. It almost felt like to me, it's like, okay, we, the Fed, we decision makers in the government cannot get this economy to start to go up again. So let's get rates at zero and see what kind of crazy wealth effect we can create. And to me, I always look at the Great Recession came directly, from my perspective, from how we were trying to clean up the dot-com era. To me, these things all seem connected. Do you feel, to me, it feels like as somebody who watched from 99 until today, there's a certain connection in terms of how the Fed has moved interest rates.
Maybe to put it into, bring back to what the Federal Reserve's mandate is. So it has two. One is stable prices, and the other is full employment. So I think a good way of thinking about it is maybe stable prices involve assets or not. There's some debate on that. But generally, the way they've interpreted it is that stable prices are about overall price inflation. And so if overall price inflation is not high, there really shouldn't be any trade-off. You want to have as much investment as possible so that as many people as possible can be employed. Put a different way, that you really do want to encourage firms to go out and make big investments that will increase productivity and employ more people. And it is less costly for them to do that if rates in general are lower. And there might be some side effects of that.
Let me bring it back more into where we're at with the headspace of your work. Can you imagine or can you posit an alternative scenario for how things unfolded? So yes, you are right to point back to March of 2020. And there was no doubt massive panic. It seems like, though, if there wasn't some of the messaging, if we knew early on that this was not affecting everyone, we knew early on that it was affecting people with particular conditions, did we need to do all of the government intervention? I was looking the other day at the Pfizer share price, and the Pfizer share price is back to levels it was a decade ago. And to me, that seems illogical, because if this was needed and if everyone took it, and then on the backside, a lot of it starts to not make sense to a lot of people. would we have been better off just letting natural market forces go forward? Because here we are in 2023. Was this the position, do you think, the decision makers in America thought we would be at in the fall of 2023?
No, I think they thought it was going to be a lot worse. I think it was fairly clear across the political spectrum that people were looking around and thinking, oh God, we're going to have another depression. And it's worth pointing out what happened in 2008 was, to some extent, we can argue about whether some of it was caused by low interest rates. Firms make their own investment decisions. Lehman fell on its own. That was the market operating. And when Lehman fell on its own, that spread. And that was market operations. That wasn't government intervention on one side or the other. The government interventions came to try to keep that contagion from spreading. We lost a decade of growth.
We should take that back. I don't know how far we can go back on that, but there was a lot of moral hazards created in the summer of 1998 when we bailed out long-term capital management. So it wouldn't be surprising to imagine that less than a decade later, firms like Lehman thought they could take all kinds of chances because they saw one of their buddies bailed out. Stuff gets complicated, huh?
Perhaps. The idea that you assume that you're going to get bailed out seems like a bad business decision. And I think the Lehman Brothers management, they sure lost that bet.
Oh, yeah, there's no doubt. They made bad decisions, and I'm not defending them. I'm just pointing out that this system that we've created seems to have gotten more interconnected and interwoven over the years and more complicated. And I guess what I'm trying to point out is, was there an alternate process? I get the panic that was unfolding, but we look at the panic that unfolded in America, but let's contrast that to the panic that unfolded in China over the last handful of years. It looks like the panic that unfolded in China just obviously is done horrors to their economy as well. It's the panic part that drives me. I was sitting there with friends and we were all keeping healthy lifestyles. We were looking across history and seeing how things had unfolded. And I guess it was using the panic to lock everybody down, essentially, to get to this place of, quote, safety, which really did not turn out to be safe because everybody got the damn thing anyways. I guess what I'm looking at is, was there an alternate universe where we did not have to do what we did from a government perspective, whether that was ginning up fear, whether that was not properly discussing who was at risk, whether that were the economic actions that took place to, quote, save everybody?
I'm sure there were. So I want to make sure that counterfactuals, anytime when thinking about what could have happened. So, and again, not an epidemiologist, but I think it's pretty clear that the United States messaging around a lot of things was problematic. But I think that that's clear in hindsight. It's less clear in the moment that we could have done something terribly differently. And just to make the distinction there, in some sense, given the fear that was happening, what we knew about this unknown but possibly really deadly virus, the economic consequences were baked in for a while there. 22 million people did get fired. The stock market did go down 30%. It really did look for a moment there like we were going to go into a Great Depression. The decline in economic output, and again, whether or not there might have been ways in which we could have headed that off through some better messaging around the virus. It's a new virus. We didn't know much about it at that point. Fear and uncertainty are real things in markets, and they really do change the way in which you can invest in what you want to do. That was a big thing, and policymakers were trying to address that. And people individually were trying to figure out, what do I do? And one of the things that people could do, if they could, was start working from home, saving and protecting themselves.
I think we're both putting out interesting perspectives to get people food for thought, to think about how this all unfolded. Let me bring something up, though, from your writing, and I'm curious to let you clarify here. It's one of these marketing lines that came from your work. It talked about how that you argue that a better, fairer, more productive economy is still possible. I'm Gen X skeptic all the way. So if I see an economist telling me that he imagines a better, fairer, more productive economy, more productive, okay, that seems fairly normal. It seems like, okay, we could have discussion about what productivity is, but that seems pretty straightforward. But better and fairer seem squishy to me. I don't know where that goes. And I saw you also use the phrase in your work, inclusive growth. Let me let you lay out some of your wider perspective here, because I come from the standpoint where I grew up in the DC area. You could probably tell my voice. I'm not necessarily a fan of government too heavily involved in the economy. I don't see that the government has any real understanding of creating wealth. I think that comes from entrepreneurs and business people that go out there and take risks and hire people and all that kind of stuff. But speak to me when you are talking about, because you give a lot of examples in your work. You give some case studies and people that had to go through certain bad periods during this particular COVID period. But speak to these words better and fairer, what they mean to you.
Sure. So first, anytime you use words like that, those are words that are subjective in some senses. And so I'm going to give you my subjective view on them, but I think it is reasonable to differ. Economists think of these things as what we call normative versus positive statements. They are how we think about the world versus what we can objectively say, this is true, this is not true about the world. So let me kind of talk about a couple of those. One of the things that's been happening over the last, if you want, 40 years, the exact timing is a little bit, that there's been a real move towards what economists tend to call capital in the economy, and a move away from labor being the other piece of it, where the people who are working end up with less of the overall economic pie than people who are providing capital. Sure, people who provide capital should get paid for it. I'm not arguing against that, but there's a balance there, and that balance has shifted pretty substantially. And one of the things that happened in the pandemic and that happened coming out of it was a huge demand for labor. And what that meant was that wages at the low end really started increasing pretty substantially. That's been really exciting in a lot of ways. When I say wages, I mean real wages. This is wages adjusted for inflation. That's meant that lots of people who are working really hard are just able to afford and able to live better than they were before. That's really exciting. In some senses, that's what I'm thinking about for inclusive. The more productive part, I think, is actually really exciting. And in fact, I think this is the biggest thing that's coming out of the pandemic, far bigger than inflation, because inflation's about how much you pay versus other things. It doesn't really have growth effects. What does have growth effects are exactly what you were just saying about people investing and making new businesses. And there was a huge boom in new business creation during the pandemic. And that's really exciting, because new business creation had been going down for the last 40 years. It's harder and harder to start a new business. Fewer people were doing it. And suddenly there's this new boom. And the pretty clear through line, although I think there's going to be a lot more research on it, is that a lot of it came from people having those excess savings, some of them coming from government payments, but some of them just because they were saving more, thinking, okay, maybe now's the time to actually start that new business. Not during May 2020, but starting in June, July, August, when things were looking better, maybe now's the time to actually start that off. What's exciting about that is it rose pretty substantially during 2020, continued in 2021, went down a little bit in 2022. And I thought, okay, that was just a pandemic thing. And it's actually increased again in 2023, which is really exciting.
I try to look at this as a continuum over time. I had a guest on this show a while back, maybe sometime this year, and we were talking about some of these issues. And I was making the case of, hey, we need to look as to how we got to where we are today and what typically might happen when you get to a position where we are today in the not too distant future ahead. And this particular guest was like, well, no, Mike, just celebrate where we are right now. Don't think about what happened before. Don't think about what's going to happen next. Just accept where we are today and be happy about it. He wasn't going to budge off that position. I thought it was really short-sighted. So here we are today. We still have elevated inflation. I think most people, in terms of their life, would argue. Now, I'm not going to argue with a government economist about the data, but in terms of anecdotal, people I know, the news reports, me seeing on the ground, it sure seems like, and look, people can always argue, no, Mike, here's the data that proves you're wrong in your lying eyes. You're not seeing what's really happening. If I just take the position and say, okay, we're still at elevated inflation and we've got rates that are much higher than they've been for a long time. And we've elevated equity prices still pretty close to all-time highs. And we've got definitely, some have come down in some areas of America, but definitely have elevated real estate prices. From that position, though, as an economist, those things generally don't all just stay together like that. I know I said this earlier in the episode, but they don't usually stay like that. It makes me feel like, and tell me how I'm wrong if I feel this way, maybe I am wrong, but it makes me feel like the prior two times in my life where I've seen the Fed push rates up to bring equities or real estate down?
Well, okay. So let me work my way through a couple of different pieces there. Making forecasts is hard. I won't be making exactly forecasts, but I think there's a real sense, first, just with high rates, we haven't yet seen anything really break. There were certainly some bank runs in February and March 2023. That was over particular pieces of things. But otherwise, they seem to have had less effect overall than I think many economists would have predicted. And so I think that there's certainly a worry that maybe things are getting more and more brittle and we're going to find out what's going to break. And when it breaks, it's going to be really bad. I certainly hope not, but that's always a possibility. One thing that has been happening, all of that excess savings, all of the money that people built up, that has more or less been spent. And it depends a little bit on what you're measuring and who and whether you're looking high income and low income. But the general trajectory is that much of that money has been spent. And so people are on average back to where they were maybe in 2019. The reason I'm pointing that out is over the last, say, 2 years, the economy's partly been doing really well because consumer demand has been really high. And consumer demand has been really high partly because a lot of people had a lot of money. We're not at that stage anymore. The next year could look very different as people re-get to where they were and have to make real adjustments in their lives that they haven't had to make for several years.
You're making the case in a sense that, from your perspective, fully out of the COVID period, we can almost imagine ourselves back to 2019, and we're still dealing with the same issues that we were dealing with in 2019.
Sadly, that seems to be where things have somewhat ended up. Again, it's always a little bit hard to, maybe some things are better in some ways, but housing prices, as you mentioned, have been really high, and housing is the biggest part of most people's budget. And so if you're paying more for housing, that just means you're paying more. And that's true across a lot of different parts of the United States. To some extent, that's partly driven by demand. Work from home is real. People want more space. That means that overall supply hasn't increased much. And that means that there's just more demand for more space and people are paying more for it. In many ways, we have returned to something that looks a lot like 2019. Now, the thing is, returning to 2019 was still a pretty good year. There were lots of problems in overall underlying consumer finance that lots of people were having problems. But in a general sense in the economy, 2019 was a pretty good year. Maybe to your previous guest point, in some ways, getting all the way back to 2019 with all of the COVID stuff baked in is a really big accomplishment.
And the question becomes, and this is where I pushed you today, and we didn't get into every particular impossible, but look, it's a controversial topic. For me, I stand outside of it and I look at the small businesses destroyed. I look at some of the freedoms destroyed. I look at some of the heavy-handedness that just happened out of nowhere. Surely several aspects of the Constitution were not abided to get to the place that the American government wanted the people at that point in time. Okay, somebody could say, well, Mike can go to court. Okay, yeah, I've done that before. It's not easier said than done. But it feels like, for me, I'm not willing to just announce or feel like, given all the side issues here that can be discussed, to just say that the government went the right path, whereas there were so many steps that it took. We could have imagined alternate ways to go. And I think that's the frightening part for the future for me, is because, I don't know, did we lay the groundwork for something even more restrictive in the future? I can think back to this one NBA basketball player, Kyrie Irving. He didn't want to take the vax. And you know what? The guy was 100% right. He should not have ever been forced to take it. It was all political. He'll never get his reputation back for that. And obviously, he's a quirky, weird guy to begin with. But he was right. He is a young, healthy guy, did not need to take it. And he got caught up in the politics of it all. That makes me not so much to try to debate Kyrie Irving necessarily, but it makes me think about the future. And that if the next something happens, it just feels like the hammer will come down so fast. There's a lot of negatives here. I mean, I still see women, whether I'm in America or Asia, I see a lot of women walking around the streets by themselves wearing masks. It's quite sad. Again, we talked earlier about the kids. They're going to be clearly damaged from the missed education. I'm really not very happy about how it all unfolded.
In many ways, I think what we've seen is that there were big cleavages in the United States over how to approach things. And so several pieces, maybe just think through. I think in many ways, it's worth remembering several pieces. One is that whatever you think about that vaccine, it was very effective and it did help reduce, at least, and again, not an epidemiologist, it did help reduce both transmission and severity. It happened really, really quickly.
I do not think that the evidence is out there about the transmission reduction. That was what was promised, but that did not happen. And I think it might have reduced the severity on some people in the extreme compromised positions, but everybody got the damn thing. So I look at it like mandating something like that. And even you right now, you say that, and I disagree with you. So where does that leave us?
Well, it probably leaves that maybe we should look at evidence. The transmission, I think I agree. My understanding is somewhat less strong than the severity piece.
Yeah, because everyone got it. So clearly, if everyone was taking these vax and everyone got the thing, the transmission part promised did not unfold.
I think the evidence is that most people had gotten it at some point, even as vaccines were rolled out. But again, I don't know that I'm the expert on the epidemiology of it. But I think the big piece there is that that vaccine came a year after this virus really started spreading. And that is a tremendous achievement. And that, just to be clear, is a government achievement. I mean, it was rolled out, but it was the development of these things, the funding of them. That's a really exciting thing. And I think it's also worth thinking there were some incipient financial crises that didn't end up happening, partly because the Fed had a bunch of tools that it developed in 2008 to think through how do you support different kinds of markets when it looks like they're going to stutter and not actually operate well. While one certainly wouldn't want to say, I'm glad we had the great financial crisis and the global financial crisis, learning from those tools so that at least they can come and support a market which might end up having bigger problems can be really powerful.
People might, and I might be one of them, but I understand why you're saying it was exciting that the vax could get through that quickly. I think on the flip side, not so exciting that essentially it became a mandate. I mean, I essentially could not travel back to America unless I took some of these vaxes, and I was not happy about that. I wonder about the market. If I look at the Pfizer share price, I'm not so sure the market participants out there think that Pfizer is so exciting, which is amazing, frankly, that it got up so high and has come down so far, which it seems to be telling some type of a story. Usually market prices do tell a story often, so it's quite interesting. I think the mandate part of the vax, look, I understand there were people that definitely were in a terrible position, compromised before COVID ever hit, very unhealthy before COVID ever hit. And if I happened to have been in that position, I would have been willing to take a new vax that came onto the market that might give me a chance. I get it. However, on the flip side, putting the burden on everybody to take that new vax and not really have the choice, that was definitely not a happy thing. From my perspective, what it makes me concerned about is the future more than anything.
I don't have a strong position on what we should do, partly because I think it depends highly on the vaccine and whatever virus is coming out. One of the things that the epidemiologists do, and this is where it comes into the economics, is that in many ways, the value of any kind of vaccine is partly what it does for you, but partly what it does for other people. And so thinking about externalities is really complicated. The hard part is when there are risks to you and some of the values are to others, we need to figure out ways to balance those things. And maybe we didn't figure out the right ways to balance them this time, but maybe we did.
That's actually a great place for us to stop today, I think, because that's ultimately the debate. Ultimately, people have to make their decision and decide where do they come down on that. And it's definitely not been decided for sure. It will be interesting to see how these things unfold into the future. Scott, you're a good sport for jumping in and taking all my hard questions, and you're very calm and collected and laying out cases and good conversation. I appreciate it a lot. The book, The Pandemic Paradox, How the COVID Crisis Made Americans More Financially Secure. You get into the nitty gritty. You're an economist. There's a lot of data in there. People might agree with your perspective. They might disagree with your perspective. But hey, you're willing to write out your thoughts and put it onto print. I always respect that. So I appreciate you coming on. Scott, is there a best place we can send people to come check you out? Book on Amazon, all that fun stuff. Is there a place they can find you?
Sure. I'm on LinkedIn. It's Scott-L Fulford. On my website, it's scottfulford.com.
Scott, I appreciate it.
Thank you very much. It's been great to be here. And I should say my opinions are my own, not necessarily those of my employer.
The disclaimer is out there. Hey, all of my opinions are my own because I am my employer. So there you go.
Well, I wanted to make sure I put that in there.
Scott, cool stuff. I appreciate it.
Thank you very much.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.